The investment world is full of terminology that you need to learn to be able to communicate with your potential investors as they're considering investing in your creative business. So without further ado, let's jump into it. The theme of this presentation is a continuation of the series of videos that I've made about raising funds for your creative business. Theme for today specifically is prepare for all of these abbreviations. First one, we're actually going to start with non-abbreviated version of the term, which is the revenue growth rate. This is a relatively simple one. All investors want to learn when they look for this metric is to understand, are you growing? The easiest way to calculate it is take your revenue from the comparable period, say from this month, August 25, and compare it to the August 24 revenue and show year-over-year comparison in the growth. Sometimes it's month-over-month comparison. If you're really high volume business, week over week, then comparison is interesting, but usually it's all about the trends. Folks likes to see different types of visual representation of this. I think the regular bar or line chart tells the best story possible because you can actually show over time how your revenue is growing. All that they're really trying to understand is, are you trending in the right direction? And if there are any blips in terms of like your revenue went down, what happened there? Or if there's spikes, why that happened, and can we replicate that spike to increase your revenue growth? Moving on with the complexity, CAC is a very popular one. Customer acquisition cost. All that it really measures is how much money you need to spend to acquire a single customer. You're a creative business. You might think that your videos are a representation of that acquisition of the customer, right? Because you post certain videos about, say, your product or the service that you're providing, or you use your quote-unquote sponsorship, your own brand, to sponsor your video, and that's how you kind of like create the top of the funnel for the potential customers to come to your business. So in that case, you take the cost to produce that specific video and you divide it by the number of customers you've acquired, and you roughly get the estimate. If you're running digital marketing campaigns, and if you're paying for the event, in general, it's always about what it costs you to, say, run that promotion. Again, whether it's a digital marketing campaign, you run some ads on Instagram or YouTube, or you went to the event and you spend money being at the event and trying to acquire customers there, or again, you produce the video, you take all that sum, you divide it by the total number of customers you've acquired, and you get a rough idea of how much it costs you to acquire a customer. This metric is very important because as your business grows, you want to first see the decline in the cost to acquire a single customer, and if it doesn't decline, hopefully the revenue per customer increases, and that justifies for you to kind of like continuously spending money to acquire those customers. It's just a better understanding of how scalable the business is, and do you need to continuously throw money at it to grow it, or will it eventually grow on its own as the customer acquisition cost goes down? This is where also it ties back to the customer lifetime value, or LTV sometimes, lifetime value, as folks would refer to it. The idea of this metric is essentially how much potential revenue can you gain per each customer. And it's not an immediate process, it's in their lifetime. If you're selling a service, is there recurring nature to it? Will they need to subscribe to your service every single month, right? To kind of like re-up their subscription? What is the average duration of them staying subscribed to your business, right? At the very beginning, you might have to just guesstimate or look at some of the other comparable businesses. But the idea is that if you can forecast and say, okay, on average, we're going to acquire one customer, they're going to have to pay us $10 a month, and they're going to at least stay with us for a year. So your estimated lifetime for that customer is $120. Why it's important? Because if we come back to CAC and we start comparing it, ideally your LTV always bigger than your CAC, because from that perspective, you show that, okay, no matter how much money it costs me to acquire a single customer, I actually make more money in their lifetime. So it justifies me spending money on that acquisition, right? So this is kind of like the dynamic between these two metrics. And as I said, sometimes it's an estimate. If your business has been out there for a couple of years, it's better and easier to understand. You might also be selling a single-use product, meaning they buy it, they use it, and they're done, and they usually never come back to you. If that's the case, then maybe your LTV pretty much equals your initial revenue from a single customer. And again, understanding better those metrics helps you understand how quickly your business can scale, how much money you need to invest in it to acquire those customers, and how quickly will you get the return on that investment, depending on what's that horizon towards generating the full lifetime value, right? Obviously, the business where to achieve the maximum LTV, you need to wait for 3 years, will present an interesting challenge of its own compared to the business where you can generate full LTV within the first year, for example. Churn rate ties back to your LTV, because churn rate is essentially out of all the customers, say you had in a prior period, say in a month, how many of them are still with you and how many basically canceled, right? Say it's a service or stop buying from you. That percentage of people who stop buying from you is essentially the churn rate. Again, it all ties back, and it's all kind of like the same nature of questions around all of these metrics, is that it helps your investor better understand, okay, what is the prospect for your business? How high of a churn rate do you have? If you have a very high churn rate, there might be a riskier business, and that LTV that you said, hey, on average, we generate, say, $120 in the customers who stay with us for a year. But if your churn rate is like 50%, there's 50% chance you're not going to get that $120. And if you invested, say, $100 in CAC to acquire that customer, there's now a lot of risk investing hard and kind of like dollars into your business to generate those customers. But then if there's 50% chance they're going to leave next month, you might be actually losing money from all of your marketing activities trying to acquire those customers. So maintaining very low churn rate is very important, because you as a business need to show that not only people come and buy from you, but they actually stay and buy more over time, or they keep renewing if it's a service type deal, so that, again, it shows better health of the business, it shows better long-term viability of your business. So across these first 4 metrics, I think, right, the big theme is providing confidence to your investor that have a profitable business, or they have a path for the business to be profitable, and it's also will scale over time, will potentially get more and more long-term revenue at the same fixed cost that you're going to spend on acquiring that particular customer. You're going to kind of like build a narrative and tell the story. And if you're not very familiar with what those metrics are, or your business is so new that you just have estimates of it, that's absolutely fine, because when you kind of like work through the financial modeling piece, and we discussed in one of the prior videos, you can estimate by looking at the comparable businesses, by just doing some research, by just doing some Excel estimation, and basically figuring out where should these metrics be. And you can put them on the board and say, here is my target. This is where I think my business will be. And as your business grows, and as you have your meetings with the investors every quarter, you'll be able to say, okay, are we meeting these metrics? If we're not meeting these metrics, where did we go wrong with the assumptions? Why the assumptions were different? So you'll be able to show and tell the story around not only the metrics themselves, but also as you evolve your understanding of the space, of the product that you're selling, and the dynamics in the marketplace. Another popular one that you're going to hear a lot about is MRR and ARR. So it's monthly recurring revenue or annual recurring revenue. Unless you're a SaaS business, subscription type business, say maybe you are trying to stand up your own membership site like Site Plus, like Mythical Society, right? This might not apply to you directly, but the reason why it's such a popular terminology and a lot of investors are looking for it, because essentially some of the highest valued businesses today are all based on MRR or ARR, recurring nature of their service. All of your subscription platforms, all the different premium tools that you're subscribing to. Adobe moved to that framework, right? And instead of selling your product once, they now charge you a monthly fee. This is why, because these metrics are very popular with the investors, and they generate a lot more valuation multiples on top of your business. So the business that sells, say, a product here and there, like a consumer packaged goods, might actually get much lower valuation per dollar of revenue compared to the business that has MRR or ARR with it. And essentially, the metrics itself, all that it really tells you that there's a recurring revenue, like there's a subscription service, people pay you $10 every month, and $10 is your MRR. ARR would be annualized amount, so basically MRR times 12 in most cases. Some companies can define it a little bit differently if there's like spikes and valleys and whatnot in their metrics. It's not like GAAP accounting defined terminology. Each company technically can define it on their own. So this is one of those things you have to be mindful of. But because you're not an investor, you're not looking to invest, you're actually looking to build a business, all you really need to understand is if there's a recurring nature to your revenue and people have to pay you a recurring fee, the amount of that recurring fee every month is your MRR. The amount annualized by 12, this is your ARR. NRR and GRR. You would think that they also recurring revenue, but actually no. It's a net retention rate and it's a gross retention rate. So remember when we spoke about churn and specifically talking about what percentage of people you lost? NRR or GRR is actually what is the percentage of the dollar amounts you kept. So it's like inverse, right, of the churn. So 100% minus churn technically should be your NRR. Net retention rate is essentially you're just looking at the bucket of the dollars you had. So if you had, say, $100 with 5 customers last month, how much of that $100 you have this month? And if it's $90, then your NRR, net retention rate, is 90%. The reason why there's a difference between gross and retention, you can have a situation where, say, you had those 10 customers, each paid $10, so that was your $100 monthly revenue. One of them canceled, so you now have $90, but one of the other ones upgraded their subscription to the higher tier, and now they're paying $20 for you every month. You would actually still see $100 of revenue, right? If it makes sense, you had 10 people paying $10, now you have 8 people paying $10 and 1 person paying $20. So you have basically still $100. So you could say, oh no, I'm good, I'm dandy, I have the same amount of money. But the better in practice, in my opinion, will be to calculate NRR first to see, okay, out of actually people who you had, did you lose anyone? And it will show you that yes, you actually did lose one person, so your NRR is 90%, but your gross retention rate, because someone else now spending more, is 100%. So you're kind of like in a decent shape. The reason why it's important, as your business scales, you might have pockets of customers who say churning a lot more. And if you have then the pockets of customers who are actually spending more and more every month, as a business overall, it might seem like everything is great and you're not losing any money at all, but you want to parse that and you want to look at those who are churning and say, why are they churning? Are they not happy with the business? Are they not happy with the service we're providing? And then you want to look at the guys who are spending more and say, why are they spending more? And can I make these guys look more like these guys who are spending more? This is why, in my opinion, GRR is a vanity metric. NRR is really what you need. But as I said, depending on the company, depending on the business, some people like showing, oh, we have 100%, 100+%. You can have like 120% GRR because people spend way too much, way more, never too much compared to the prior period. But as I said, it might hide problems in your business. And that's why it's always important to look at NRR as well as a business owner, but also when it comes to showing to the investors, smart investors, sophisticated investors, they will be looking for an NRR number because, as I said, many businesses try to hide problems in the business by only showing GRR, and sophisticated enough investor, they will say, no, show me your NRR, show me your net retention rate, how many actual dollars you kept, instead of covering it up with all those upsell opportunities. Gross margin comes back now to the product dynamic itself or the service dynamic. All that it really is, the revenue that you make for that product and how much it costs you to create that product. So cost of goods sold. Can be defined differently. Different accounting, practices can increase or decrease the number. So it's, again, a lot of it based on methodology of how you calculate, especially the cost. Or if, say, you have multiple revenue streams, or say the person, when they're subscribing automatically to several different products. How do you allocate the revenue across multiple products in a single bundle? So there are different methodologies, but you're likely creating a business that only has single revenue source. So in the easiest terms, if, say, it's, again, let's go with you're standing up your own membership, kind of like website. How much revenue you're making from the memberships minus how much it costs you to run the website, to pay for all the services, maybe subscribe to certain like tools on the back end to process the payments, to process the videos or whatever the content you might be putting out there. So you basically go and you calculate this. Usually exclude bigger items like SG&A, what they call. Basically, the idea of SG&A is like it's your standard operational expenses, right? It's maybe your salary, it's salary of your finance team or salary of your tax team. It can be even salary of some of your engineers. Frequently, you would exclude it if your engineers work in multiple different things. It's purely trying to understand, are we burning money and not making enough to justify the expense that we're putting into the providing that particular service or creating this product? If, say, it's a physical product and you're producing, a bottle of water, how much it costs you to produce that bottle of water, right? So it's the cost of the water on the inside and the cost of the packaging itself, and then basically taking that and subtracting it from your revenue that you're making per each bottle. It helps you, again, understand better dynamic of the business. And sometimes it's okay at the very beginning to lose money on each unit sold because maybe there's some upsell opportunities, or maybe you anticipate that as you acquire a bigger portion of the market, you'll be able to increase the price a little bit. Gaming consoles is a great example. Many gaming consoles, actually, especially in the past, they were sold at a loss. So the gross margin was negative for, like, say, PlayStation 4 or PlayStation 3. But then Sony knew that, hey, they're going to be buying our games. So as they buy the games and we make 15-20% fee on each one of those games, we're going to be able to make up for the loss. So they need to only buy like 5 games, and then we make up for the loss in the gross margin. So depending on the business, depending on the dynamic that you're creating, it can be different. But it's an important metric to consider because, again, you're showing your investor how healthy your business is. And if your gross margin is negative, you're going to have to speak about how are you going to get to the point where your gross margin turns positive. Now, equipped with these metrics, you pretty much can explain a lot about your business. Obviously, there are things like volume of goods sold. You can talk about how many customers you have. You can talk about some other different quantifiable metrics around your business, maybe how much people spend time on your website, how many times people come back to your business, right? Like a lot of those things really purely depend on the type of business you're creating. That's why I'm not necessarily digging too deep into them. But I do want to talk a little bit about a few unique metrics that's very popular, or at least you'll hear people refer to them. And I just want you to be aware of these next 3-4 metrics that when they come up, just know what they mean. And if they're applicable to your business, be able to calculate them. One of those metrics is Rule of 40. So Rule of 40 is really more applicable to the SaaS businesses. You can apply it to a lot of other businesses, but SaaS is really where it's kind of like super popular. Sound fancy. All that it really means is that what is the sum of your gross margin, which we just spoke about, and your growth rate. So idea here is that if you have a business that has a 20% gross margin and grows at 20% year over year, you have a very good and healthy business. That's all that it is. It seems like it's made up, and it's kind of is. It's just something that the entire business like industry agreed on, that those two numbers should be roughly equal 40. It's an idea, and it's a way for quick and easy communication of what's the health of your business. Because, for example, if your gross margin is 0, right, you're not making money, you're just breaking even on each product sold, then you better be growing at like 40%. And if you're growing at 40%, you can tell the story, hey, gross margin is 0, but we're growing at 40% because we're focused on acquiring the market share. So we're not worried about making profit right now on each product sold. Or vice versa. Maybe your growth rate is only like 10% because you're already a mature business. You're trying to kind of like just slowly grow in double digits. Then you better show some solid gross margin. And like showing 30% gross margin tells you, hey, we now have a very healthy cash generating business where we're still growing at like 10%, which is not bad every year. But then we make 30 cents on every dollar, right, that we invest into this business, which is awesome. It means it's a cash cow, generating cash, and maybe there's some opportunities for you to extract that cash down the line as an investor in the form of, say, stock buyback, if it's a public company, or say, for example, the dividends, right? So again, we're going a little bit too deep on the financial side of things, but all that it is, it's just quick and easy way to communicate the health of your business. And you might ask, Tahir, what happens if your gross margin is minus 10%? Then you better be growing at 50%. And again, the story can be there. We're just acquiring market share so fast that we don't even care about making money at all. We're actually burning cash. That's why we came to you, dear investor. We can grow for the next year another 50%. We just need a few $1,000,000 to kind of like generate the stock and inventory to go provide and sell it to the customers. That's it. That's all that it is. There are plenty of issues that I have with this metric. Again, it's one of those that I consider vanity metric. But as I said, it's just a quick and easy way when you have a 30-second conversation with an investor in the hallway, you can throw at them, hey, this is what we do. This is the amazing things we're doing. And by the way, we're hitting Rule of 40. And it can be, interesting. So you're already mature enough, or you're growing fast enough that you're actually at Rule of 40. Tell me more. Made up scenario, might not happen, but just an interesting metrics to know. EBITDA. I'm going to skip the entire accounting class on how it's calculated. All that you need to know about this is that what it stands for is earnings before interest, tax, depreciation, and amortization. It's a very popular metric. It's a very, I would say, on the sophistication level, it's further up there. You need to be a much more mature business. If you're just in your like seed, pre-seed stage, don't even worry about it and just know what it stands for. And all that it really stands for is your business profitable? That's all. So traditionally, all you would do, you would take all of your revenue minus all of your expenses, and is that number positive? If it's positive, great, you generated cash. If it's negative, do you have enough money in the bank account to keep paying for something that you're losing money on? EBITDA just became a more sophisticated financial methodology because then you can start debating about like, oh, you have interest payments on the debt that you raised, but you also have taxes. Do you kind of like, how do you adjust for that? Do you also have depreciating assets? Maybe you have a factory, maybe you have certain like, office building that you acquired, things of that nature, and there's amortization on different investment. Maybe you have like some sort of like big investment upfront and you want to amortize it across the lifetime value of that product, right? Again, gets super complex. A lot of those things, even I sometimes find myself kind of like scratching head, primarily because this metric, all you need to know, this metric was created on purpose to, and it's a controversial statement, I should prefix that, so it's my personal statement, to create a little bit of a noise and veil around the true profitability of your business. Because you can be losing money on the business, but if you do all of these adjustments, right, you like remove the interest charges, you remove the tax, you remove depreciation, amortization, you're like, hey, I'm actually profitable. But in reality, when it comes to the bank account, you started your month with $100, you ended your month with $90, you lost $10, right? You're losing $10 every month as a business, but EBITDA might show you that you actually gained $10. That's how it works. It's basically allows you to like, put some glitter on that entire situation and pretend like you're a much more healthier business. As I said, controversial. There's good reasons to have this metric because a lot of those kind of like things like interest charges can fall off, taxes can change, depreciation, amortization can change depending on kind of like how assets allocated and where you allocate them. It's just a way to, as I said, create a little bit more sophistication around how you calculate net profit or just honestly cash flow for your business. Early on as a business, all you need to focus on how much money you spend, how much money you gained, that's your number. But as your business matures and as you start facing more sophisticated investors, you will have a finance team or you'll at least have an accountant who will help you calculate EBITDA. And that's going to be one of those metrics that's going to be prevalent because a lot of the valuations for the startups, especially like as you enter like Series A stages, will be looking at the multiples of EBITDA. And I spoke about it in the past, but just to quickly touch on it, a lot of companies value it based on the multiples of either revenue or EBITDA or maybe some other metric, right? Depending on the type of business and what the industry kind of like settled on. Not PE ratio sometimes, right? Things of that nature. But EBITDA is very popular. And for example, for your category, when someone evaluates your business, they can say that business will get 10x on every dollar in EBITDA. So that's why it's important to understand, because if you EBITDA like $1 million and it's a $10 on every dollar of EBITDA, all of a sudden you have a $10 million business. So that's how it kind of like works. And it's a way to, again, communicate the value. Theme around all of these metrics is really not something you need to be calculating to really know your business. It's more about how you use these metrics to communicate the health of your business to your potential investor. Debt to equity ratio is kind of like a similar. Actually, I would argue for the business also it's important to know and understand. The whole idea here is that what's your leverage like? Are you over levered? Like meaning for the entire value of your business, and if say it's a $1 million business, how much debt do you carry right now? If you raise some debt, is it 100K, 200K? Is it $500,000? Is it $1 million? Right? And so your debt to equity ratio is 1-to-1. There's not necessarily a lot of negatives to it. It's a good metric to know. Really, what comes into play, the quality of the debt, right? Like, are you paying some egregious interest rate on that debt, or actually it's pretty reasonable, or maybe even it's delayed and there's like, some benefits that you created from it and there's no like convertibility to it. Like, there are a lot of questions around the quality of the debt and type of debt that you raise. So on its own, this metric is not always like straightforward and easy to understand, but it just helps you, again, as I said, theme is help people understand the health of your business. And if your debt to equity ratio is like it's all equity, that's awesome. That actually will tell folks like, hey, there's some room. If you're like cash flow generating business and you have no debt, you might, instead of giving up your equity to your investor, maybe you just raise debt and you pay interest rates, sure, but you get to retain the equity in your business, right? So that's one of those things that kind of like helps you better understand like how much money you raised and whether you raised it using debt. And if it is, then again, as I said, questions will come up around what your interest payments look like. Do you have cash flow to support those interest payments? Things of that nature. So all in all, it really just tells people how much debt do you have and how it compares to the equity in your business. And finally, one of those popular ones, and especially as you go a little bit more mature and you start facing, especially PE guys, private equity guys, IRR is a big one for them. IRR is really an internal metric to like VC funds and private equity funds. What it tells them is essentially it does the whole like net present value calculation. Again, to save you time, net present value calculation is all that really means. What is the value of your dollar today compared to the dollar that you're going to make X number of years from now? The reason why it's important for PE shops or VC shops is that whenever they work with their investors, their LPs, right, limited partners, they need to be able to tell them, hey, you're making more money with my fund than you're making with by investing in a mutual fund somewhat there in the public market, right? Or investing in some other opportunity. And you need a comparable metric. And so that's where IRR comes in. IRR is essentially gives them an idea of like, hey, if you're going to invest $5 with me today, you're going to get 20% return 5 years from now, as an example. So then investor can say, okay, so you're going to give me roughly 20%. If I go to this other guy, his fund will generate 15%. And if I invest in the market right now, a mutual fund can actually generate for me 25. Okay, I'm going to go invest there. Or maybe your IRR is much higher as an investor, but then the risk also increases. And maybe you go just buy some treasury, much more stable, much more predictable, and kind of like you take less of a IRR, less of a growth rate, right, on your investment as an investor from more safe investment rather than like private equity fund or VC fund. So that's all. You don't have to calculate it. It's their headache to go calculate IRR and defend their IRR calculation. All you really need to know is that when that IRR conversation comes up, the proxy is how will your business contribute to that metric if they are to invest with you, right? It's important for them because if you're growing very fast and you're a very profitable business, it actually will increase their IRR and it will keep their LPs happier, their investors, right? Basically investors of the investors that you're working with. If you're negative, you're kind of like diluting their IRR. That might be the reason why they say no. Or if they do say yes, maybe they put you in a separate fund or not even create a fund and just make like cash on cash investment kind of thing. And just an individual deal. So again, never worry about having to calculate it. Just think about the dynamic and how your business will contribute to that metric for those investors. And if they bring it up, as I said, it's their headache to calculate it. You just need to know whether you're creating amazing like investment opportunities for them long term. And I promise there are a lot more other different terminology and abbreviation out there, but I think these are some of the more critical ones. They're the most popular ones that come up all the time. So hopefully by now you understand a little bit better and the dynamic, the reason why the people will ask about these metrics. And as I said, for your business, you might eventually generate new and additional metrics to be able to evaluate your business. At the end of the day, all of these metrics, with the except of a few that I mentioned at the very end, should be aimed at helping you understand the health of your business and monitor for any potential issues in your business. Everything else, those ones that I call the vanity metrics, they're usually created to help you quickly communicate to someone the value of your business without having to explain the entire business structure, because that's usually the challenge, is that you understanding what your ticket volume for the support is like, or what's the, I don't know, number of actual customers who are active on your website on any given day. Those are great metrics to have. If I'm an investor who invests in multiple different businesses, I might just not understand fully the dynamic, but I don't need to. That's your job. You're the owner of that business. You're the one who created it. You need to understand those metrics to understand the health of your business. Me as an investor, tell me a few things like what's your rule of 40, tell me what's your churn rate, what's your growth rate, right? Talk to me a little bit about what's your debt to equity ratio? Are you over levered or not? Tell me about the health of your business, how quickly it's growing, right? Again, those metrics that are easy for me to understand, that I can glance over on a single slide in like a minute and quickly assess how healthy is a business that I'm looking at. And then you build your narrative around it. If you're curious about the narrative, I made a couple of videos both about how you build that narrative through the investment conversations in the past, maybe like 5-6 videos, but also I did a couple of analysis of the pitch decks for like Chamberlain Coffee, for Mr. Beast, so you can learn a little bit more about how they build the narratives over there. Let me know in the comment section below if you have any other questions, any other metrics you want me to highlight and talk about, and I will take a pause on talking about the investments for a little while. Probably, maybe, we'll see. I like this topic, but I want to switch gears and maybe talk a little bit about some of the other businesses. The economy has been changing. There are a lot of other interesting topics that I can talk about, how it's going to impact the creators long term. So stick around. As I said, let me know in the comment section below if you have any other questions. Otherwise, I'll see you next Saturday. Peace.